Okay, I'm recording this video. It's Sunday, 25th of September 2011, and we've had some epic moves in the silver and gold market over the last couple of days, and I thought it was time I record a video on trading gold and silver. Just to give you a quick summary of the points I'm going to cover in this video, show you all the charts behind all of these points. But first of all, gold, silver, and also platinum, closely correlated markets. The first myth that I'll try to dispel in this video is that gold is a safe place to invest during a financial crisis. I'll show about 30 years of history and show you that that is actually not the case. The facts are, gold actually rises when there is political unrest and money printing, particularly in the post-2000 era, and that gold actually falls when the financial crisis actually hits and the stock markets get hit. From my perspective, keeping your trading capital in the strongest currency is one of the things, it's a kind of currency overlay that I try to do on a long-term basis. Once, maybe twice a year, I'll shift my base trading capital into the strongest currency that I can find at the time. And so I don't trade FX kind of on a day-by-day basis, but on a long-term basis I am actually looking at the FX markets, and gold is inversely correlated to the US dollar. So it's helpful to look at gold in order to see what is happening in the US dollar. And so there's this kind of complex of markets, gold, silver, the euro, the Aussie and the pound, that you can look at as a group in order to get signals for being in and out of the US dollar. And that's how I look at gold and silver. So I don't trade them per se, but they're part of this group of markets that I look at in order to judge the strength of the US dollar and whether I want to be in the US dollar or out of the US dollar for my base trading capital. So that's the summary. Let me just go through the charts. So the first chart here is of daily chart of silver, and this is what's just happened on Thursday, Friday. We've had this huge run up in silver up to just under $50, which was the Hunt Brothers kind of psychological high in price 20-30 years ago. And during April we had a peak just under 50, and the market kind of came off after this kind of extraordinary kind of exponential move up to $50. We've had this kind of bear flag come back up to test 45 kind of area, and then Thursday, Friday we had a huge collapse from $40 down to $30, and we finished on Friday at $30.10. So silver market is actually down 40% from the highs here. Yes, it's still up kind of double what it was a year ago. It was kind of just trading under $20 a year ago, and it's kind of almost double that. But this move laterally in silver has been pretty epic. Gold chart shows similar type of pattern, not as extreme in terms of the percentage moves, but we've had this topping out activity in the gold market as it's gone kind of a little bit hyperbolic here into $2,000 almost, and then the last couple of days we had this correction down to first 1800 and then now into the 1600s down here. So the first point to make is that gold and silver are closely correlated, and here's a very long-term chart back to 1975, monthly chart of gold and silver down below here, and you can see if I put a marker on here, these highs in the market, the lows in the market kind of correlate almost exactly between these two different markets. You can see kind of the low down here, these kind of relative peaks, relative lows and the highs and so on, extremely tightly correlated. There's been a traditional ratio between gold and silver that kind of moves within a fairly narrow band. Interestingly, leading up into 2011, silver got a little bit out of whack in terms of that ratio, and the last kind of exponential move up into $50 here in silver has been as that ratio has kind of reasserted itself between gold and silver, and we had a really runaway move in the silver market here. The second market that people really don't kind of talk about all that much is the platinum market, and it's a precious metal just like gold and silver, and similar kind of turning points and kind of trend points in terms of platinum and gold and platinum and silver. However, you can see kind of laterally the run-up that we had into 2007-2008 in platinum was huge, a lot higher than the run-up that we had in gold. The sell-off was equally kind of extreme, the timing of which was very similar to the gold and silver market, but had different kind of levels and different kind of moves that were happening. The major difference between platinum, silver and gold is that platinum and silver are consumed. They're used in a lot of chemical processes and everyday kind of electrical processes for silver and so on. So platinum and silver get consumed, gold does not. Gold gets used in jewelry obviously, but usually it's kind of viewed as a store of wealth, whereas silver and platinum have more kind of industrial uses than gold. Let's talk about gold and this myth that it's a safe place to put your money in uncertain times. And I'm just going to run through some long-term charts here. So going back to 1975, I put up some breaks in this gold chart and put it against the S&P 500 index here on a monthly chart. I've used a log scale on the S&P here. It gives a little bit of better kind of sense of what the percentage moves are kind of going on looking on a log scale. But let's just go through these kind of point by point. The first kind of huge run-up that we had in the gold market, and kind of peak in the gold market, was 1979. And let me just refresh everybody's memory what was happening in 1979. 1979, we were in the midst of kind of extremely high inflation. We had the second oil crisis where Iran stopped shipping oil to the US. We had the Iranian Revolution, November 79, and we also had the hostages taken from the US Embassy in Tehran. We had Soviets invading Afghanistan. We had the UK general election where Margaret Thatcher kind of came in, and that was the result of huge mismanagement by the economy by the Labour government previously, in the winter of discontent in 1978. So around 1979 it was pretty scary times, a lot of kind of political unrest and very uncertain things going on, and that got reflected in the price of gold. You can see it kind of spiked up. However, the stock market kind of kept on going, and when gold did come off, the stock market did come off as well from these peaks, but gold was reflecting at that point the political uncertainty that was going on. The next kind of little blip up, spike up that we get in gold is about 1982. 1982 we had the Falklands War going on between Argentina and the UK. We had a whole bunch of high profile collapses. We had the DeLorean Motor Car Company failed, we had Laker Airways collapse. We also had the Unabomber started to be kind of active at that time. Pope John Paul II, there was an attempted stabbing of him. We had the start of the Lebanese War. We also had a debt crisis in Mexico that then got replicated in some Latin American countries. And lastly, we had all the shipbuilding, Lech Walesa and the Polish shipbuilding in Gdansk problems, and the beginning of rumblings kind of behind the Iron Curtain and the falling of the Eastern European bloc. So again, highly political charged environment, and that got reflected in a rise in the price of gold. And the stock market kept on rising during that period, but then spent a couple of years kind of going nowhere and actually went into a decline. So we had the economy kind of coming off after we had this kind of spike in uncertainty in the gold price, and as the gold price declined, the share market declined. A little bit later we have 87, so this is Black Monday, the 87 crash. Coming into that, we had a small rise in gold kind of going on, a lot of uncertainty, a lot of people feeling that the markets were getting a little bit overbought and so on. And so as that correction happened in the stock market, then gold kind of went off, but the stock market continues its rally. 1983 we get another little kind of spike in the gold price in an overall downtrend at this point, but in 1983 we had the Iraqi disarmament crisis. So this is after the first Persian Gulf War, and this is when Saddam Hussein refused to let independent observers in to look at the disarmament process, and we had a crisis there. And then at the same time the North Koreans withdrew from the Nuclear Non-Proliferation Treaty, and for the first time we got extremely worried that North Korea was going to be starting to turn their nuclear technology towards armaments. We also had the Bosnian War starting again back in Eastern Europe, and so again a highly charged kind of political environment. We got a spike up in the gold price. Stock market wasn't doing very much at that time, kind of didn't do anything very much, but the decline in the stock market was then kind of, we had a small decline in the decline in the gold price was replicated in decline in the stock market kind of over the next couple of years. Next kind of blip up that we get is just leading up to 2000 in gold price, and this was the millennium bug fears. Everybody thought that planes would fall out of the skies, the ATMs would stop working and so on, and just leading up into 2000 there was a lot of kind of panic buying of things that you might need in the event that modern civilization came to a grinding halt. I mean, we kind of laugh about it now, but during the time when we were living through that, there was real worries that there were going to be problems with the millennium bug in 2000. So that was what was reflected there. And of course the stock market did peak in 2000, and we had the tech bubble on the Nasdaq, and we got a huge kind of sell-off after 2000 in the Nasdaq particularly. And then latterly, since 2000, really, what for me has been kind of, the trend changed from a downtrend into an uptrend in gold, and this really reflected an overall view that after Alan Greenspan stepped in after the tech wreck and brought rates to zero and effectively pump primed the economy with cheap money and so on. That was when the view became more mainstream that the Americans and the Fed in particular would do anything in order to maintain the strength of the economy at the cost of the US dollar, and they would print money in order to get out of problems. And so that got reflected, the money supply and the money printing got reflected in a strengthening of gold versus the US dollar, as we have kind of the weakening US dollar, a strengthening in gold. And then the last two kind of blip ups that we got in the gold price into 2007, 2008, where we got kind of uncertainty over the global financial crisis and subprime contagion and so on. But note, the price of gold went up as the stock market was still kind of making highs, but then the price of gold fell with the stock market going down. And just lately, so what we've had in gold, we've had a peak up to 2000, almost hit 2000 on gold price, just as we've had this sovereign debt crisis that comes out of the pig nations in Europe. But the similar kind of problems are being replicated in all the developed countries around the world, and it's how these sovereign debt issues are going to be worked out. The worry has already been reflected in the gold chart. The question is now, as gold kind of comes off, is the actual problem going to be reflected in the stock market as we've seen kind of before? The rise in gold then gets reflected in a fall in the stock market, and then gold follows the stock market down at that point. So hopefully that's kind of enough history over the last 30 years to suggest that gold is not the safe place to invest during a financial panic. It's a place that the gold price reflects the uncertainty, the money printing and the political uncertainty that goes on before a panic actually gets replicated in the stock market, and the stock markets start to decline. But when the markets are down, the gold price will go down as well. For me, the more important correlation is the correlation between the price of gold and the dollar, US dollar. I've just plotted on here, so we've got again the monthly chart gold against here, 30 years, 1975 to 2011. And we've got the dollar index here, the DXY, the Dixie. I've put that on here, and then I've just added, for convenience, this inverse indicator. You can see it's showing the inverse of the gold price. So let me just hide this away. And there's the inverse of dollar versus gold price. On the face of it, you look at this and you think, well, they're not as kind of tightly correlated as you might think. But let me just run through this, because I think the highs and lows are really important. You can see a trough in the gold price is replicated by a trough in the inverse of the dollar, so there'll be a peak in the dollar index. And then as we come up and make this kind of high in the gold price, you can see that this inverse does kind of max out in terms of a low in the US dollar. And then this whole move down is signaled quite nicely by this inverse function here. We get at the bottom here, bottom of this trough, and then it's followed by a rise over about 3 years into this kind of peak, and then we kind of come on down. Then the index kind of moves up a little bit. The correlation index moves, I beg your pardon, the inverse indicator kind of moves up a little bit as the gold price is kind of moving down. We get this function here, and then we get into this final decline from about 1995 to 96 to 2000, 2001, where they're very closely correlated. And the low here, which is signaling a high in the US dollar, a low in this inverse indicator versus the absolute low in gold, which is in the 400s, is very nicely signaled. And then they start to move together quite closely. Get the gold price kind of goes nowhere for a period of time when this index kind of goes down, and then they start to take off again in unison together. They peak quite nicely at this point here, move down in sync, move up again in sync, and then the final peak as we move into here. So this is the inverse of the dollar index versus gold, and you can see there's a tight correlation between the two. And then because gold is correlated with silver and to some extent platinum, all of those three are kind of moving in inverse relationship to the dollar index. So you can use those markets to judge moves in the dollar index. And what I do is, on a kind of a long-term basis, I use my kind of better indicators on those charts, silver, gold, dollar index, and also the currencies, the euro, the pound, and so on, in order to judge what's happening in the US dollar and whether I need to be in or out of the US dollar. So just looking at silver over the last few weeks. So On a weekly chart in silver, we had this huge run up into $50. You can see blow off activity in terms of better momentum, huge readings here, professional activity on weekly charts, bang, 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 3 weeks in a row, just marked the top up there in the 50s, and we kind of dropped down really sharply here. We kind of bottomed out with a bullish divergence signal down here, some amateur down bars kind of testing the lows at this point, and we came back up. And you can see on this weekly chart, we've made this pullback to end of trend sequence here. And what was interesting, the last few weeks, trying to hit these new highs at 44, we had amateur up bars on weekly charts coming into that end of trend signal, extremely weak buying, bearish divergence signal there right on the zero line, and this thing just collapses in this last week. On a daily chart, we've got one of these nice kind of synchronized turns where, again, it's a little bit bunched up here, but there's on a daily chart an end of trend, in synchronized with an end of trend on the weekly chart. So we've got two of these patterns kind of coming together. You could see the run up in silver price, bullish exhaustion buying activity, all these blue professional bars and so on, and then latterly this activity coming into this new high, testing back up with bearish divergence right on the zero line, amateur up bars at this point, and now we've fallen through cyclical support, two large blue professional bars kind of falling through the ice at this point, and this moving into a strong downtrend at this point here. So you can use the indicators on the silver chart. Gold, similar type pattern. We've definitely had the blow-off activity in terms of on the weekly chart. Blue professional up bars, profit taking, exhaustion buying, but we're coming down into a pullback and an uptrend sequence at some point. So gold will get caught at some point in the next few weeks, and then kind of make another rally up. On the daily chart for gold, you can see here that we had, again, coming into these highs, profit taking, bullish divergence. As you can see, the amount of buying, the large buying happened into this first peak. The second peak here, testing back up at above 1900, extremely weak buying, all these bearish divergence signals right there. We tried to make a pullback, but we fell through that, and we get kind of falling through the ice at this point. So we'll form some kind of support on gold at some point and rally back up, but silver was kind of leading the markets in this way. And then, so if gold and silver are kind of the inverse of the US dollar, obviously the currency are the inverse of the US dollar as well. So I like to use the euro charts, and these are the euro contracts that are traded on the CME. So they're futures contracts that give me volume data as well. And sometimes, some of the currencies move within large kind of trending swings, and you can see those trending swings using better sine wave highs and lows here on the monthly charts. Yes, sometimes we break into very strong trend moves, but also we move in extremely wide moving kind of cyclical patterns on monthly charts that kind of represent fairly big swings in the market. So euro lastly just peaked out, kind of exhaustion buying, $1.50 here, cyclical turning point on a monthly chart. When you go to the weekly chart here, we've kind of had a double top, if you like, kind of testing back up to $1.50. Interestingly, moving into this $1.50, look at all these no demand patterns that kind of came up. Just showing at 148 to 150, no one's buying this market. Better momentum starts to really weaken substantially. We fall through our pullback level, and we're into downtrend on the weekly chart. And on the daily chart, similar type pattern, you can see we're batting backwards and forwards between these cyclical highs and lows, just in this large kind of channel until we finally found a strong move in one direction. We've kind of moved down to 136s, and we've had cyclical support kind of come in. The question is, is that going to hold? It looks like we're kind of poking through there. Is it going to kind of continue on down into a strong downtrend on the euro? And then the dollar index, because again the dollar index is also traded. You can look at this again on the using the CME data for the futures contract for the dollar index monthly chart again, and this will be the exact inverse of the euro chart, if you like. You can see we had this strong downtrend in the dollar index. We've been moving between these cyclical highs and lows lately. On the weekly charts, we had a similar kind of pattern. We kind of bottomed out with all these no supply patterns down here, bullish divergence kind of coming in here. We've had a really strong rally over the last 3 weeks, and we're kind of breaking into an uptrend. And if we look at that on the daily chart, again, we were in this kind of tight consolidation range here. We've had these couple of blue professional bars getting this move going. We've broken through cyclical support resistance here, and this is kind of jumping the creek at this point and getting this move going with these blue professional bars. So that's using the better indicators on these markets, and they can work as long as you've got kind of volume if you're using the CME contracts in order to get kind of volume signals as well as the price signals using better momentum, better sine wave, better pro-am. The other way of looking at this is also to use commitment of traders data. Now, over the last couple of years, I think everybody kind of knows I've fallen out of love a little bit with my commitment of traders analysis. I find it less useful, certainly with short-term analysis, but on the longer-term analysis, there's still some value to be had by looking at this. But the first point to note is that commitment of traders on gold and silver really doesn't give you very much information at all. So 4 charts here. The first one, gold weekly, gold monthly, silver weekly, silver monthly here. And just beneath this, what I've plotted is the commitment of traders numbers for each of those weeks and each of those months. So you can see a short-term and a long-term kind of picture of commitment of traders here. I've just flipped the commitment of traders, so positive commitment of traders numbers here means that the professionals are short, which means the professionals are most likely kind of hedging. So the major players, the professional players in gold and silver markets, are actually the producers themselves. They're not traders or hedge funds or any people like that. They're actually the miners who mine gold and silver. And so most of the time what they're doing is hedging. And so what I find is with my signals on the commitment of traders data for gold and silver, they're really not extremely useful. But they are useful for the currency markets, and I'm going to show you a couple of charts here. The first one, this is Euro weekly and Euro monthly, and here's the commitment of traders numbers. Again, what I do is I flip these upside down so that negative numbers are actually professionals being positive numbers, I beg your pardon, are actually professionals being short. And then what I look for is bullish and bearish divergence signals between the price data itself, the currency, and the commitment of traders numbers. And all I've used is the algorithm that's within better sine wave any. If you actually happen to own better momentum any will allow you to plug in the commitment of traders data there and get these kind of bullish and bearish divergence signals. And on these higher time frames you can start to see bullish divergence signals. You know, as we come into this high on the euro 155, 156, we had the commitment of traders numbers coming off and we showed bearish divergence signals here. We had some nice bullish divergence signals here, marked a low in the market here. And latterly what we've had on the monthly charts is, you know, again kind of bearish divergence signals coming on the euro. And when we look at that on the weekly, we also see the same kind of things here. You know, the fall off in the professional activity here versus what the price of the euro was doing at that time gives us that bearish divergence signal there. So they are actually quite useful, and this is one of the reasons why I'm quite bullish on the dollar index at the moment and kind of bearish on other currencies. I've actually had this position for about 3 or 4 months. I've been sitting on my dollar index positions rather than in terms of my base trading capital, and missed a little bit of a rally in the Aussie dollar, but you know, I've been happy with that because I think it's working out in the long term. And on dollar index you can see exactly the same thing. So we get commitment of traders numbers for the dollar index. Again, commitment of traders on the weekly and a monthly and a weekly chart here, and you can see the bullish divergence, bearish divergence, bullish divergence, and so on these charts. And this is why this whole series of bullish divergence signals here coming into the lows in dollar index is one of the reasons why I've been quite bullish on the dollar index kind of lately. So that's my suggestion to you, is that you might be an E-mini day trader just like me, but there is value in watching these kind of other markets, correlated markets, and this kind of whole complex, if you like, of gold and silver, and then the euro, and then the other currencies, for example, like the Aussie dollar and the British pound. You'll get bigger swings, more beta in the Aussie dollar, less beta in the British pound here, but they're also kind of moving in sync against the US dollar. So all of this complex will be moving against the US dollar, and it'll give you an indication. For me, it helps in signal kind of the longer term moves where the strength in the currencies is going to be, and you can look at the gold and silver markets as part of that whole kind of complex. So there we go. Just to bring up the summary again, so to say, gold, silver, platinum, closely correlated markets. Hopefully this myth that gold is a safe place to be during a financial crisis, I've kind of dispelled that. We've had this gold price rise, which has been reflected by, at the moment what we have is political unrest and money printing going on by the Fed. But, once the financial crisis hits and once the stock markets get whacked, gold will fall as well. So, and potentially with Thursday, Friday's activity that we saw in silver and gold, that's the real kind of start to this kind of correction move. Keep your trading capital in the strongest currency possible. I'll probably have to do a video at a later date to show you how to do that. I do it using Interactive Brokers and their multi-currency accounts to move my base trading capital into the strongest currency at the time. And then look at these markets, the gold, silver, euro, Aussie, pound, and so on complex, as a group in order to help you kind of move in and out of the US dollar in terms of these longer term trends. So there we go. Hopefully that was helpful after an epic week on the silver and gold markets, and I hope you're enjoying your weekend.